Okay, so it actually happened. This morning, the United States put 50% tariffs on about 20 billion of Canadian goods, including lumber. And here's the thing. The Bank of Canada hasn't touched your mortgage rate in 6 straight meetings. In 10 days, they meet again. So does a trade war cut your mortgage rate or raise it? The annoying truth, both at the same time. And whichever side wins decides your next payment. In the next few minutes, I'll show you which way it's leaning and the one move to make this week. Before we start, I'm Raghav Manchanda, a licensed mortgage broker in BC and Alberta. No politics, just your payment in this video. So let's go. 60 seconds on what exactly happened. And fair warning, I'm going to talk about both governments the way I talk about weather. Because for your mortgage payment, that's all they are. So talks collapsed at the deadline early Saturday morning. The US hit us with 50% tariffs on roughly $20 billion of exports, steel, aluminum, autos, lumber. Ottawa says we'll match it dollar for dollar starting September 8th. Now, whose fault is it? Ottawa says the US asked too much and offered too little. Washington says Canada moved the goalposts. They're blaming each other, and for your mortgage, it changes nothing. The storm is here, and let's do the forecast. But here's a detail almost nobody has mentioned, and it's my favorite part of this whole story: the bond market. So the bond market is the market that actually sets fixed mortgage rates. It closed on Friday before the talks collapsed, but the 5-year Government of Canada yield ended Friday evening at 3.37%. Flat, calm, no idea what was about to happen Saturday morning. Which means, as you're watching this, the market that prices your next fixed rate hasn't even voted on this yet. Monday morning, that's the first vote. And when it votes, it's got a real problem on its hands. Why? Because a tariff shock pushes your mortgage rate in two opposite directions at the same time. Let me show you the fork. Okay, the fork, once you see this, every headline for the next 2 weeks will make sense, I promise. Number one, tariffs push prices up. A 50% tax on imports plus our counter tariffs on American goods means the stuff we buy gets more expensive, and that's inflation. And inflation is the one thing that stops a central bank from cutting rates. It can also push bond yields up, and bond yields track fixed mortgage rates up with them. But force number two, tariffs kill jobs. Almost 3/4 of everything Canadian exports goes to the United States of America. You slap 50% on billions of that. Orders shrink, shifts get cut, people unfortunately get laid off. And a weakening economy, that's exactly what makes a central bank cut rates. And cuts are what pull variable rates down. So which is it? Prices up or jobs down? Both. Both are real. Both started this morning, and the Bank of Canada, parked at 2.25% for 6 straight meetings, has to pick a side on September 2nd, which is the next Bank of Canada rate meeting. And here's the part that got me. This exact scenario was called a month ago. BMO's senior economist Robert Kapchich said in July that the bank was firmly on hold unless trade relations with the United States got worse. If they did, he said, it could, quote, open the door to easing again. Well, somebody just knocked on that door. Does that guarantee a cut on September 2nd? No. Central banks hate reacting to 2-week-old news. But the path for your mortgage rate genuinely changed this weekend. And if you live in BC, there's one word on that tariff list that makes this really personal. And that's the one that national coverage keeps skipping: lumber. It's on the list, and if you're watching from BC, that's not a trade statistic. That's the interior, that's mill towns, forestry jobs, trucking, Prince George down through the Kootenays, communities where the sawmill is the economy. Now, why does that matter for your mortgage? 2 ways. One, the Bank of Canada's math. Job losses concentrated in export industries, that's exactly the kind of economic deterioration that pushes them towards cutting. BC forestry pain is literally an argument on the cut side of the fork. Two, your local market. In a mill town, when the mill slows down, buyers get nervous. Listings sit on the market. Prices soften. Doesn't matter what rates do. So if you own or you're buying in a forestry town, the tariff story and your housing market just became the same story. And if you are in Alberta, you're not off the hook either. Steel and autos touch you, and a retaliation on September 8th cuts both ways. Your exposure just runs through different industries. If you want the Alberta version, tell me in the comments and I'll make it. Okay, so with all that in motion, what do you actually do this week? Depends which of three chairs are you sitting on right now. Okay, so chair number one, you're holding a variable. Honestly, this news leans your way. The recession force is the one that cuts your rate, and that door just reopened. The one move I would caution against, and I know some of you are thinking about it, is panic locking into a fixed rate as soon as possible, out of fear, before markets have even repriced. Don't decide on adrenaline. Don't decide on panic. Know your numbers. Watch September 2nd, decide on information. This brings me to chair number two. You're shopping for a fixed. Your rate lives in the bond market, and the bond market votes Monday morning. If recession fears win this week, yields fall and fixed rates can actually improve. If inflation fear wins, they climb. But here's the thing you don't have to guess. Get a rate hold. It's free. It locks today's rate for you for up to 120 days. And if rates drop, you just take the lower one anyway. In a week like this, a rate hold isn't paperwork. It's free insurance for you. And this brings me to chair number three. You're renewing in the next few months. Everything I said in the renewal video just got more true. Do not sign the letter your bank mailed you. The entire rate landscape could look different after September 2nd. Keep your options open. Full renewal playbooks on the channel. Links below. This brings us to the date that answers all of this. September 2nd. That's the day the Bank of Canada tells us which side of the fork it's on. Hold the line against inflation or open the door to cuts because the economy just took a hit. I'll break that decision down the day it lands. So if you want the answer the moment it exists, subscribe. Until then, three things. Variable holders, don't panic lock. Fixed shoppers, get your free rate hold this week. Renewers, don't sign the letter. And if you're not sure which chair you're in, my line's in the description, and so is a booking link for my calendar. I'll give you a no obligation honest assessment of what you're in for. And the politics are going to stay loud, but your mortgage doesn't care who wins the argument. Remember, it takes care what the Bank of Canada does about it. Now you know what to watch for. See you in the next video.